Tokenized stocks, your profits untaxed. Everyone is buying the AI boom through chips, but a chip on its own is deaf and blind. To build a supercomputer, you have to wire tens of thousands of GPUs together so they act as one machine, and move oceans of data between them every second. At AI speed, copper wire cannot keep up, so the data now travels as light through hair-thin strands of glass, and the company that quietly became the toll road for that light is Corning, ticker GLW. Here is the case, step by step. Start with what Corning actually sells into AI. Not the chip, but the nervous system around it. The optical fiber, cable, and connectors that link every GPU, every rack, and every data center together. This is the boring layer nobody watched, and it is now exploding. Last quarter, Corning's optical business did about $1.85 billion, up 36% in a year, and the profit from it nearly doubled. They built a new kind of AI fiber that packs up to 4 times more capacity into the same space, and last quarter they simply could not make it fast enough. Production was tripling month over month, and management expects demand to keep outrunning what they can build for roughly the next 2 years. Now the part that turns a good story into a contracted one. The biggest names in AI are not just buying from Corning, they are locking it up years in advance. Corning signed a deal worth up to $6 billion with Meta, then signed 2 more hyperscaler deals of similar size. NVIDIA committed up to $3.2 billion to fund new American plants and 10 times the capacity. And in June, Amazon signed a multi-billion-dollar supply deal of its own. When Meta, Amazon, and NVIDIA all sign multi-year contracts for the same glass, that glass is no longer a commodity. It is a bottleneck. And Corning told investors exactly how big this gets. Their plan, which they just raised, is to nearly double the company to a $40 billion annual run rate by 2030, with a brand new photonics division alone targeting $10 billion. This is not a chip that gets commoditized next cycle. It is the connective tissue of every AI factory being built, sold under contracts that run for years. Now there is a second story hiding inside Corning, and it is part of why optics-focused investors have quietly made this one of their largest holdings. The next frontier in chips is advanced packaging, stacking chips so tightly they behave as one. And the industry is starting to build those packages on glass. Intel's foundry chief has called glass substrates a key part of future packaging, and TSMC confirmed it is piloting glass for its most advanced packaging, with volume aimed at the back half of this decade. Corning is one of the few companies on Earth that can make that glass at scale. And some supply chain watchers push the idea one step further. As chips stack thicker and run hotter, they argue glass is emerging as the answer for cooling them too. Be clear, all of this is a 2027 and beyond option, not today's revenue. But if even part of it lands, Corning stops being just the wiring between the chips and becomes the platform they sit on. So let me argue the other side honestly, because for this stock it is the whole point. Corning is not cheap. After a run of roughly 190% this year, it trades at more than 70 times forward earnings, while Micron trades below 10 and even NVIDIA around 22. A lot of good news is already in the price. The analysts who just raised their targets still land, on average, slightly below where the stock trades today. This is the opposite of a bargain. It is a quality and momentum story, priced for the boom to keep going. 2 more risks you need. 1. Most of Corning's other businesses, display glass and solar, are flat to shrinking, so the entire thesis leans on AI optical staying hot. 2. That demand sits with a handful of hyperscalers, and if their spending cools, the richest valued suppliers fall first. Even Corning's own CEO has said he is deliberately hedging in case the data center boom slows. So understand what kind of stock this is. It is not a quick trade. It trades this expensive precisely because the market is paying up front for years of contracted growth, which means the only way the price makes sense is as a long-term hold. You buy it to keep, while that growth compounds toward the end of the decade, not to flip it on the next pop. On a short horizon, it is overbought and can pull back hard. On a multi-year horizon, if the build-out keeps going, you own the company that takes a cut of all of it. So here is the whole thesis in one line. As AI shifts from single chips to entire buildings acting as one computer, the scarce thing becomes moving data between them, and Corning sells the glass that carries it, under contracts that run for years. That is the reason to hold GLW for the long run. Not because it is cheap, because it is not, but because almost every AI factory being built for the rest of this decade will run on its glass. One more thing, and for this stock it matters more than anywhere. Price this richly, the price you pay is the entire game. So the last question is a simple one. How should you own it? Through a broker, you trade market hours only. On-chain stocks trade 24/7, 365, straight from your wallet. We prefer on-chain for one reason above all. Your profits stay yours, untaxed, already trading on Ondo and X stocks. Not financial advice. Do your own work on the price you pay.